wish you all a very happy New Year 23. We continue to have a constructive outlook on equities, especially for investors with a long-term investment horizon. We would urge investors to look beyond volatility, which would be very likely through the new year. In the recent years, COVID and the Ukraine conflict came from nowhere. I can only hope there is no such development in 23, but a diversified asset allocation would be a good safeguard. Sticking to an optimum asset allocation is required to deal with the unknown unknowns. In the new year, the world will be watching for the success of the steepest and most widespread global rate hike cycle ever undertaken. The magnitude of success in controlling inflation and the collateral damage on global growth will be important. These outcomes and the possibility of new policy errors will be the biggest possible source of volatility for the Indian equity market in 2023. India itself is expected to have a stable domestic macro and ongoing high-frequency data suggests that the global outlook remains robust as well. Stable domestic macros should be aided by, number one, declining and controlled inflation trajectory. Number two, possibly supportive monetary policy in the later half of 23. And number three, robust tax collections keeping the fiscal deficit along the projected glide path. Urban consumption should sustain its strength. In the new year, things are looking better for the rural economy and rural consumption as well. Rural growth will be helped by the easing of inflation, strength in construction and real estate activity across the country, improving terms of trade for agriculture, and possible policy support in a pre-election year. The uptick in the ongoing credit cycle and the real estate cycle should hold up in the new year. Investments, both private capex and public infrastructure, should be steady in 23. These will be aided by delevered corporate balance sheets, a cleaned up banking system, improving capacity utilization across industries. Having emerged after years of cyclical and structural reset, many industries ranging from banks, automobiles, housing, telecom should continue to do well. We expect corporate earnings growth to be reasonably broad-based and robust in the coming year, aided by margin recovery and operating leverage. However, despite a relatively stable domestic macro, India cannot be immune to a weak global economy, especially the linkages through the export sector. While starting aggregate valuations might suggest a measured upside in the near term, we strongly believe both the Indian economy and corporate growth face structural tailwinds. This will help relative performance of Indian equities in the years ahead. Volatility, while inevitable, would be best navigated by sticking to an asset allocation plan, investing in equities systematically or through a staggered approach, and looking at the asset class with a long-term investment horizon to benefit from the power of compounding. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.